Christmas was supposed to be quiet. The screens were supposed to go dark. People were supposed to breathe, but the silver market did not cooperate. Right now, one hard number out of Shanghai is blowing a hole through the story you see on your broker app. In China, physical silver is pricing near $80 per ounce. Here in the United States, the paper quote is still sitting in the low 70s. That gap is not normal. It is not healthy. It is not a trading opportunity. It is a warning, because when two prices exist for the same metal, the market is telling you one thing: delivery is becoming the real price. Let us slow this down and look at the hard contrast, because this is where the story breaks open. On your screen in the United States, silver is trading in the low 70s per ounce. That is the number most people see. That is the paper number. Futures contracts, digital promises, click buy. Click sell. Clean, fast, comfortable. Now, look at what is happening on the ground in China. Physical silver. Settled, paid, delivered. After converting the Shanghai futures settlement price, adjusting for currency, and translating kilograms into troy ounces, the number comes out near $80 per ounce. Not someday. Not projected. Right now. That is not a rounding error. That is not volatility. That is a gap of nearly $10 on the same metal. At the same moment in time. In a normal market, that gap should not exist. In a healthy system, price differences between regions are tiny, a few cents, maybe $1 during stress, because the moment a gap opens, the arbitrage machines wake up. Buy where it is cheap, move the metal, sell where it is expensive, the gap closes, gravity restored. But that is not what we are seeing. Instead, the gap is widening. This is where language matters. Professionals do not call this a spread anymore. A spread implies order. This is disorder. This is a broken market, because the force that normally keeps prices aligned is not working. And here is the key point. The price in China is not a speculative price. It is not driven by chart traders or momentum funds. It is a settlement price tied to physical delivery. That number represents what buyers are willing to pay to make sure silver shows up in hand, on time. Meanwhile, the price in New York is still a paper reference. It reflects what traders think silver should be worth, not what factories are paying to keep running. When those two prices diverge like this, the market is voting, and it is voting with real money, real contracts, and real delivery. Ask yourself a simple question. If silver is nearly $10 cheaper in New York, why is every bank, hedge fund, and trading desk on Earth not buying it there and shipping it east? This is supposed to be free money. Risk, free profit. The most basic trade in global commodities. The answer is uncomfortable. They cannot. Either the silver cannot be sourced fast enough, or it cannot be moved. Or it is already spoken for. Somewhere between the vault and the runway, the metal disappears. And when that happens, paper and physical stop talking to each other. This is why this matters so much. When the physical price leads and the paper price lags, the paper price does not get to argue forever. Screens can lie for a while, vaults cannot. History is very clear on this. When two prices exist, the one tied to delivery always wins. It does not win politely, it wins suddenly, because the moment confidence breaks. The question changes. It is no longer what is the price. It becomes, will I get the metal at all? And once that question enters the room, the old pricing system is already in trouble. To understand why this situation is so dangerous, you have to understand how this market is supposed to work when it is healthy. There is a simple mechanism that keeps global prices aligned. It is called arbitrage. And under normal conditions, it is relentless. The process is boring when it works. Step 1, buy silver where it is cheap. Step 2, move the metal. Step 3, sell it where it is expensive. Step 4, collect the difference. That trade is not optional. It is the gravity of the commodity world. It is what prevents prices from drifting apart. In a functioning system, if silver in New York is cheaper than silver in Asia, the metal flows east. If Asia is cheaper, the metal flows west. The gap closes quickly, sometimes in hours, sometimes in minutes. That is how the world stays stitched together. Now look at what we are seeing today. Silver is trading far cheaper on paper in New York than it is settling for physical delivery in China. The profit is obvious. The incentive is enormous. This should have triggered the largest arbitrage rush in years. Every major bank has teams and algorithms built for exactly this situation. And yet, Nothing is happening. The gap is not closing, it is expanding. That tells you something critical has failed. This is the moment where most people reach for the wrong explanation. They say maybe traders missed it, maybe it is a reporting error, maybe it will fix itself overnight. That thinking belongs to calm markets. This is not a calm market. The correct question is not why the gap exists. The correct question is why no one is able to exploit it. The answer is simple, and it is unsettling. The metal is not moving. Paper contracts can be traded in milliseconds. Physical silver cannot. A 1,000-ounce bar does not teleport. It has to be located, loaded, insured, cleared, shipped, refined if necessary. That process takes time. And more importantly, it requires available metal. Right now, that availability is in question. If the silver in New York were truly sitting idle in vaults, arbitrage desks would be draining those vaults around the clock. Planes would be booked. The gap would collapse. The fact that it is not tells you the silver is either already spoken for, already pledged, or not where it is supposed to be. This is what people mean when they say the paper price and the physical price have divorced. The paper market is still pretending supply is abundant. The physical market is screaming that supply is tight. When arbitrage breaks, the entire pricing system loses its anchor, because paper prices are not self-enforcing. They rely on delivery as the final referee. Once delivery becomes uncertain, paper loses authority. This is why the situation escalates quickly once it starts. The longer the gap stays open, the more confidence erodes. And confidence is everything in a market built on promises. Once buyers believe that delivery might be delayed, or rationed, or denied, they stop asking what is the cheapest price. They start asking what price guarantees metal. And when that shift happens, the market is no longer negotiating. It is repricing. This is not about speculation. It is about logistics. It is about trust. And right now, the bridge that connects the paper world to the physical world is cracking under the weight. And when that bridge finally gives way, prices do not glide to a new level. They jump. This is where most people misunderstand what is happening. They assume a price near $80 means speculation. They think this is hedge funds chasing momentum or retail piling into a hot trade. That assumption is wrong. And it is dangerous. The buying pressure coming out of China right now is not emotional. It is not chart-based. It is operational. The dominant buyers in this market are not traders. They are manufacturers. They are factories. They are procurement desks whose only job is to make sure production lines do not stop. For a trader, silver is a position. For a factory, silver is a component. Without it, nothing moves. Think about the decision-making process on a factory floor. If silver costs $70, production runs. If silver costs $80, production still runs. But if silver is unavailable, production stops completely. Workers go home, contracts are missed, penalties trigger, customers walk. That is the math they are doing right now. This is why the buying is price inelastic. These buyers are not asking if silver is expensive. They are asking if silver is available. That is a completely different question. And it leads to completely different behavior. Start with solar manufacturing. China dominates this industry. For years, analysts said silver demand would fall because manufacturers would thrift it away, use less silver per panel, replace it with cheaper materials. That process already happened, and it hit a wall. Newer, high-efficiency solar technologies require more silver, not less. The industry has reached the physical limit of substitution. You cannot remove more silver without sacrificing performance. And at the same time, output targets keep rising. That combination forces buyers into the market regardless of price. Now add electric vehicles. The next generation of battery technology dramatically increases silver usage per unit. Traditional vehicles use small amounts for contacts and switches. New battery designs use silver as a functional material. Not decorative, not optional, functional. That changes everything. When a manufacturer looks ahead and sees a future where silver intensity per product is rising while global supply is flat, the rational move is not to wait. It is to secure inventory early, even at higher prices, especially at higher prices. This is why silver is being treated like a strategic input, not a commodity. The buyers stepping in now are not thinking in weeks or months, they are thinking in years. They are locking supply before the rest of the world wakes up. This is what an industrial run looks like. In a financial run, people rush to withdraw cash. In an industrial run, companies rush to withdraw metal. The logic is the same. Trust in future availability breaks. Everyone moves at once. And unlike traders, factories do not sell into rallies. They buy until they are secure. Once inventory is locked, it stays locked. It does not come back to market just because the price went up $5. This is why the $80 price matters so much. It is not the top. It is the signal that industrial buyers have crossed a line. They have decided that waiting is riskier than paying up. When that decision spreads across sectors, the market does not cool down, it tightens. And when industrial demand collides with a paper market that assumed abundance, the adjustment is never gentle. It is abrupt. Because production does not negotiate. It either runs or it stops. And right now, factories are choosing to pay whatever it takes to keep running. At this point, the story no longer lives on a chart. It lives in warehouses. It lives in inventory reports. It lives in what is quietly disappearing while most people are distracted. Look at the visible silver stockpiles tied to delivery in Asia. Over the past few years, those inventories have collapsed. What once stood in the thousands of tons is now a fraction of that. More importantly, the metal that is actually available for immediate delivery is approaching zero. This distinction matters. Not all inventory is created equal. Some silver sits in vaults as eligible metal. It exists, but it is not for sale. It belongs to long-term holders, institutions, or private owners. Registered inventory is different. Registered metal is warranted. It is ready. It is what the exchange relies on to settle contracts. When registered inventory falls, the system loses its buffer. And that is exactly what is happening. Large quantities of silver are leaving registered categories in short periods of time, not slowly, not seasonally, rapidly. This is not normal drawdown. This is removal, gone, taken, reassigned. This is the behavior of buyers who do not trust future delivery. You can see it in the structure of the market itself. Spot prices in China are trading higher than futures prices. That condition is called backwardation. It sounds technical, but the message is simple. Buyers are saying, "Do not promise me metal next month. I do not believe you. Give it to me today." In commodity markets, backwardation is the heartbeat of shortage. Under normal conditions, futures trade higher than spot because storage costs money. When that relationship flips, it means availability is more valuable than time. It means possession beats promises. Now connect this to what is happening in the West. Vault operators are reporting delays. Refiners are booked solid. Requests to allocate physical metal are taking longer than they should. In a modern digitized system, bars are supposed to be located instantly. When someone tells you they need time to find your metal, it raises a question no one wants to ask. Is it really there? This is where confidence starts to fracture. The physical market does not need headlines to panic. It moves quietly. One procurement desk pulls forward orders, another does the same. Suddenly, what looked like sufficient inventory is gone. This is why the arbitrage gap refuses to close. The metal that would normally flow to equalize prices is already being absorbed. Every ounce removed tightens the system further. And the tighter it gets, the less credible the paper price becomes. This is the paradox at the heart of the squeeze. The same demand that pushes prices higher in Asia is draining inventories in the West, making it impossible for the paper market to respond. The mechanism designed to stabilize prices is feeding the instability. This is not theoretical, this is not sentiment. This is inventory leaving the system. When visible stocks fall fast enough, the market does not debate fundamentals anymore. It reacts. Because once inventory confidence is lost, price becomes the only rationing tool left, and price does not rise slowly when it is forced to ration reality. Now we arrive at the most dangerous part of this story: timing. The U.S. market is reopening during what traders quietly call Ghost Week. The days between Christmas and New Year, volume evaporates, senior traders are away, decision makers are offline. What remains is a thin order book, skeleton crews, and automated systems running on rules, not judgment. This is the worst possible environment for a price disconnect. In a liquid market, big orders get absorbed. In an illiquid market, small orders move price. When liquidity disappears, prices do not walk, they jump. Now, layer in the global time mismatch. Asia opens first, while New York sleeps. Shanghai trades. If the physical price in China holds near $80, that information exists long before US desks are fully staffed. By the time New York reacts, the tone is already set. This is how gaps form. Add one more accelerant, options. There is a heavy concentration of call options clustered just above current paper prices. When price approaches those levels, The institutions that sold those options are forced to hedge. They buy futures to reduce risk. That buying pushes price higher, which forces more hedging, which pushes price higher again. This is called gamma pressure. It is mechanical. It does not care about holidays. It does not care about opinions. Now, imagine that feedback loop hitting a market with no inventory cushion and no sellers willing to step in. One industrial buyer places a hedge. The order hits a thin book. There are no offers where the price was 5 minutes ago. The order slips upward just to get filled. Algorithms see the move. They detect the price gap with Asia. They join in. Suddenly, price is chasing itself higher in an empty room. This is what traders call an air pocket. Price does not climb step by step. It skips levels. It gaps. And because the physical arbitrage bridge is broken, nothing steps in to slow it down. Here is the key point. This move would not be driven by news. It would not be driven by emotion. It would be driven by structure, by timing, by absence. When markets are well supplied, volatility expresses itself as noise. When markets are undersupplied, volatility expresses itself as repricing. Ghost week removes friction. Gamma adds fuel. The East sets the tone. The West scrambles to catch up. This is how a paper market loses control without warning. And once price resets upward to meet physical reality, it rarely comes back down to the old fiction. Because the buyers who force the move are not trading. They are securing supply. This is why the risk right now is not a slow grind. It is a sudden adjustment, the kind that happens when everyone realizes, at the same time, that the old price no longer clears the market. And when that realization hits during a week with no liquidity, the move can be violent. What you are watching right now is not a rally. It is a transfer of authority. For decades, paper markets told the world what silver was worth. That only worked as long as delivery was assumed. That assumption is now breaking. When supply is abundant, paper sets the price. When supply is tight, physical takes over. $80 is not a spike, it is a signal. The market is moving from comfort to survival, from promises to possession, from screens to vaults. The question is no longer where price trades today. The question is who still has access when the metal is gone. Because once reality sets the price, it does not ask for permission.